Hi guys, so let's take a look at the potential impacts of inflation on an economy. Now before we really get started, I just want you to pay attention to this red box that I've just drawn up here. Now the reason for this is because these are really useful evaluative points that you'd be able to use when it comes to any inflation changes. And the first one is really that it depends upon the rate of inflation in the economy. The higher the rate of inflation, the greater the price change, and therefore the greater the impacts there will be for each of these points that we'll run through. Nice and straightforward that. Secondly, predictability. So if prices are actually going up 5-10% a year, then it means businesses can actually plan for that. They can adjust their costs, their prices accordingly, and therefore increase the price in line with expected inflation. Now, in addition to that, it also means for their wages, they will also be able to increase staff wages to correspond with the change in inflation rate. So therefore, the predictability is important, and thus, if inflation is not predicted, that's when these impacts will really be quite profound in most circumstances. And finally, the rate of change of inflation in other countries. This is particularly important when it comes to the balance of payments point that we'll make at the bottom here. So let's take these in turn here. Firstly, reduced purchasing power of consumers. It sounds pretty obvious, and it is really. Inflation means that prices, of course, are rising, so it means that your pay packet will actually be able to afford less goods because of that inflationary effect. Next one, menu costs. Now, when it comes to menu costs, of course, it's really a matter of just updating prices, and there is a cost incurred in doing so. Then we've got the search costs, and search costs could involve the costs of actually searching for other potential suppliers who may be able to offer the product at a cheaper price, and it's just those additional costs that can be incurred as a result of changing suppliers and looking for new alternates. Okay, next one, money or inflation illusion. Now this is an interesting one because it's really about households' perception of their income, and if households' perceptions are founded around nominal wages rather than real wages, then this can also be quite significant. It's really a psychological effect here, but it can really undermine the way in which households manage their finances. Okay, so we mentioned this reduced purchasing power of consumers and the loss in real earnings there that they would experience. So if they only perceive their nominal wages are exactly the same and aren't aware of their actual real incomes changing, then yes, it can have an impact on household financial management and mean that many households will actually overspend because they are not aware of those real changes in their actual income levels. Okay, next point is about redistributional effects. Now, the redistributional effects is really about the borrowing and the saving and lending that takes place within an economy. So if inflation is relatively high, this is great news for people that are actually borrowing money. Those that are in debt will benefit from high inflation because it erodes the real value of that debt. Meanwhile, lenders, who of course are savers for a bank, and that money is relent by the bank, suffer a loss in their real value of the savings that they actually have, or the lendings that they're actually making, so those loans they're making. Okay, next point is another nice one, in economics. Okay, so fiscal drag, and that is really as wages rise, some may find themselves in a higher tax band. Okay, now that in itself can mean that you have certain middle income earners who end up paying a higher rate of tax on part of their earnings. Now, as they get dragged into that higher 40% income tax bracket, then it means tax revenues could actually rise, and that could improve the the fiscal budget there. Okay, so nice technical point, that one about fiscal drag. And then we've got balance payments issues, okay. Now when it comes to inflation, of course, it means that your exports prices will actually be rising quite quickly. And that will make your exports far less price competitive in foreign markets. Meanwhile, import prices will be far more stable, and therefore imports will become more competitive than your export products. This can lead to a worsening trade position, and of course it can also lead to a depreciation of your currency as less of your exports are actually demanded from overseas. Okay, right, so that's it. Just remember these points here. You know, this all comes down to how quickly a price is changing. The greater the price change, the greater these effects will be. Okay, thanks guys.